What's popping G? So DaavileFX is back. As you can see, I have now my website is kind of running. I'm not happy, but I'm also not satisfied with the results. So I hope you can find value here with the system and services that I'm offering. If not, you can go to the blog section, and here I'll be posting as consistent as I can. For me, I'm better at writing that I'm at video. It's not that I'm bad at video creating, maybe I am, but it's more that I'm not good at video editing, so that's other skill that I'm working with. But for now, the website, SEO, optimization, speed, blah, blah, all those things are ones that I'm taking care. And the investing model or the system itself, I need to keep it up to date with new data, so that's my priority all the time. So here, even though I'm still using, and I apologize in advance, I'm not trying to lie about that, but I'm using AI to translate. It's not that my English or my grammar is that bad. I'm usually writing very casual because I'm not thinking about it. But when I do think about it, I'm kind of decent. So I just usually use AI to fix some grammar or basic grammar or punctuation. But for now, I'm relying on also the SEO optimization of the post I'm doing, but this will change, so don't worry about it. You won't be subscribing to something that it's just ChatGPT. So just wanted to add that. So the last two posts are the ones of today, so let's cover these ones because we have a lot of action with gold. So as you can see, we have clearly this bullish trend being formed starting this after this push. We have a very good push at the triple top area. We have these reactions when the rates started at the last 3 semesters of the year. We have also two pushes before the in the previous first rate cuts. But after the Trump, the new year, the Trump drama, the tariffs, and etc., and the Fed most likely not cutting rates at this stage was pre the January rate cut, so we can assume that investors are already assuming that it won't happen. So with all the drama that is going on in the USA economy, with the ongoing wars that at this point we don't have information yet about any cease of fire or anything, investors naturally will position for gold. So as you can see this area, I have it marked, sorry, because it was very important. You can see the reaction. In 2024, we are not used to break all-time highs or touch important zones and have a big reaction to the opposite side. Like, it was very common in the past years that we only had two previous all-time highs, 2011 and 2020. Like, there's a big gap in years and time between the break of two all-time highs. That used to be the deal when economic panoramas were more stable. So yeah, it was easier to trade in past years than it is today, so don't be too rough with yourself. We are experiencing probably the worst 1 year and 2 months of the history of markets because of the nasty amount of volatility. Even though we have tons of bullish pressure in the gold asset versus the dollar, you can see we have tons of retracements, and that's why I'm one of the best traders in the world. That's why my algo is above any retail AI expectancy or high frequency trading with tons of indicators, because I just trade retracements. Like, it's very basic to do it. And even though 2024 is one of the worst case scenarios for me because it's only going up, we have tons of retracements, so my efficiency is in how good I am at those retracements. So how you can apply this to your own knowledge or to your own advantage. Of course, we know we have tons of retracements, but we don't know when they want to happen. So especially the first push of the trend, and data shows that January and February are very, very chill. Let's go to a clean chart. I'm already scrolling in tons of lines. So for example, here, I can tell very clear this December. This exact week is in December. Those are, let's mark them as something that won't happen very often. This is very unusual. This week is insane. This is the 4 hour. So this is something that won't happen again, especially the sector of the move. This is more of an unusual situation than anything. So for normal situations or normal markets, you expect something like this. This is January 2024 and the last part of 2023. So if we compare the conditions, we have currently January around here. Let's mark it around where it ends. But it's very important to note something. What's the difference between this range and the 2024 range? Of course, 2023, the USA elections. That's the only difference. What happened here? Why the recovery started? It's not only because, and actually it's not anything related to Trump or Kamala elections in this specific drop. This is related to the Fed and the inflation, unemployment, and the positive data that was at least being released at that point. So the panorama was shifting slowly to push for a more positive narrative. We already had 2 cuts, so we were waiting for the third one, and we had the third cut. So it was looking very, very good. So you have the first, the last part of the year. Everyone is chilling, like there's nothing to do at this point. Markets, it's not that they will close, they stay open, but there's no liquidity. There won't be real big moves, and this is the all-time high of 2024. So if we measure the amount of the all-time high versus the close of the year, it's nothing. It's only $25. If we compare versus the total move, we opened December at 1987. Like, this is nothing. The risk of a good investor putting good money into the market at this price in the end of the year with market ranging, it's very high. Because even though it recovered and it was going to be an excellent trade, there was the possibility, we could assume, that Trump administration started with other decisions or calls, because we cannot assume it's the wrong decisions or calls if they were just made. We need to wait for the actions to be have a reaction, pretty much. Not everything is wrong and not everything is bad for everyone, or not only good to the USA, because we can say that Trump is doing things in behalf of the best interest of USA and some others that are very shady, or whatever. In this situation, the price reacted to the upside because they don't trust him, and most likely they don't trust Elon Musk and the age of Trump, because he seems to be just someone saving its own reputation after being 2 steps from jail. So markets are reacting against the dollar after the Fed gave us this major push and these 2 retracements. Like, this is the work of the Fed. Let me show you versus the whole panorama of 2024. So people have more respect on Powell. Like, I can't stand someone throwing bricks at Powell because he is a real champ. So compare the total push, you can measure it. Only until here we will be only 2024. Say $800 move. We started the year more or less at 1985 and we closed at 2787. It actually more, 2796 more or less was the all-time high now. 2790 we could say, depending also on the broker. So you could say your investment was very, 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 very good in this 2024. They say the S&P 500 had a good year at 25%, I think. Mind you bought gold at the beginning of the year, some leverage. That's a good trade. But we can see the short periods of recovery. The Fed decided to not cut at the beginning. It was actually a 50-50 at least that would happen. It didn't happen, of course, so markets reacted, but things seem stable. Besides the wars and the external factors, things seem stable because at this point, after the 2023 closing, the signs will be that if there's no rate cuts, that they will be high or some higher rates, and that's the unemployment will be triggered and the consumer sentiment, like the natural idea will be that people will be afraid of traveling, spending, going to games, blah blah, and it's all the contrary. Like they are spending like all the other years that rates were at 0%. So it's not that the labor market or the consumer market it's very efficient at this right now after the lockdown, but is that people is not afraid of throwing money away because they have a job, they have something stable. There's no risk of. It's very different. Unlike 2011, the risk was they were they will save the institutions, the banks, or not. And if they don't save them, then who is going to collapse first, and who is going to get taken down because of the like a domino effect. And it happened at some stage until the government did take action. They had to raise the rates very high, but that was mainly because they had to put money into something that was gone. In the COVID, the situation was the lockdown, and the lockdown meant that people couldn't work because of a virus, not because of a stupid, dumb shit that banks did that pretty much collapsed the economy. The issue with the 2011 is, for example, people couldn't pay the 3, 4, 5 and growing mortgages and rates that they had because they were readjusting year by year. At one point, they were going to be paying 3 times or more than the original value of the property. So it was insane. It was insane. Unless people with 5, 10 houses that they couldn't afford to pay even one. So they will get 0 houses at the end. They will be thrown to the streets. That's something major. The COVID situation was very different. We all know that also was very terrible, but we cannot compare a lockdown with a human mistake of that magnitude. So I see things very stable. I don't think there's need to be very dramatic at this point with the prices of gold being so high, because at any given point they will just drop like any other year that we had interest rates so high, because that's the only thing we can do. We can only go back in time and check data, check facts, what will happen, because we are doing the same that Wall Street, that the Federal Reserve, that the governments are doing, the central banks, that is try to react, because we don't have anything else to do unless we're predicting the future, okay? No one predicts the future, no one. So the Federal Reserve is not fixing this. This is going up, the gold chart, because they cannot predict the future. They need to take decision by decision, step by step, see how the economy reacts, the people react, the other countries react, their debt, how the inflation. We have indicators for that. It's like just like a company, but you are tracking the countries. An economy is way bigger than a company, and it's way more complex. But at the end, we have the federal, the Forex factory. Have the news. We have everything condensed here in folders. At least this is a very basic measure, but very advanced for non-traders to have a real understanding on what is moving the market at certain times and why. Like you don't need to keep things very complex at the analysis. The execution can be complex. how you trade, how you enter and exit trades, how you trail, that needs to be complex, I agree. But the analysis, the fundamental, even the technicals, even if you want to have deep manual understanding or price action, candle understanding, liquidity, volatility, DOM, profiles, whatever, you still need to keep things simple, because you cannot be pretending that something is happening because of your understanding of technical factors when you're having a third world war happening right now, in a hypothetical case. Like, you will be going against the reality. That's what I mean. Don't try to get too much into something that you don't know for a fact it works, and nobody knows for a fact it works, because at the end it's the same. No one knows the future. So just try to keep the things very simple. Check the XAUUSD analysis first. You can check then this post I share with you for rebates and some strategy that I'm testing. As you can see, this is an insane volume of trading. It's insane amount of trades. It's going not bad, not good. It's positive. It's a testing for a client. You'll see. I don't want to spoil anything, so just go to the Davile.com. You can check the blog, and here in the blog, it's the last two posts in all posts. These two show you the analysis and the high gains. I'm gonna leave the links in the description anyway, so you can check them. And for now, this will be it. It was more like a sermon, you know, like a Sunday sermon that someone in the church will give, but it's something important. I feel is relevant to provide some key insights on how someone sees the markets, so others can understand, apply, or do the opposite. That's also valid. So for now, that will be it. Just have a good one. We still have things to do, so we will be active. I'll try to post more often as soon as I can, so stay tuned.